All right, all right. Welcome to the show. This is the Weekly Jargon. I am Jose Rodriguez.
And Rohi Zachariah.
And today we're absent Abel Perez, but we do have a guest with us today. We'd like to start off the morning by kind of giving you updates on how the economic environment is after these tariffs. But with no further ado, let me go ahead and introduce our guest that's joining us live today, and he's joining us via remote. So this is Justin Poor. He is a financial advisor, and he's also an enrolled agent, and he's going to go ahead and provide us some updates on how the tariffs have impacted us here since April 2nd and how the market can affect us moving forward. So go ahead, Justin, if you can hear us.
Hi, all. Like Jose said, Justin Poor. I'm a financial planner and tax accountant out of my broker dealer is Osaic, and none of the views presented today is an expression of any kind of advice or solicitation. That's most important to explain. But going into the importance of what is happening in the economic cycle today is that the fact is that we had a lot of liquid money. We had a lot of savings still from clients and people and the economy and the world. And ultimately, I've talked to so many different people between civics professors before all of this happened. So that's an important aspect to remember in that every really high interest rates for people. So it's very interesting in what's happening today in the fact that it almost seems like a rush to safety, if you will, based on a
Okay,
fear.
Justin, if you're there, I'm sorry
And
we
what
we
that
are losing. I'm not sure if we've lost the signal there, but
are you there? Might have lost you. I see you guys. I'm gonna just keep talking. The main the
yes. Well, with that, Justin has. Are you there, Justin? Looks like we've lost Justin with that remote, and we'll have to bring him back here hopefully next week, so that he can give us a an update. Justin, if you can hear us, we're going off and on. I think we're losing a signal there, but we will come back to you. We will come back to you, and we'll go ahead and see how we can go ahead and get you back here as a guest. We'd like to have you here live so that we can provide some good financial information. Again, these are we're not necessarily a tax attorney or a any financial advisor other than giving his personal perspective of what he sees out in the market. Obviously, Rohi and I also have some finance background, but that's only in our personal portfolios that we carry. But we certainly would like to have Justin out here to give us a bit more a breakdown of what he sees, especially being a financial advisor in this environment. So, Rohi, as of yesterday, I saw my 401k and wow, 9% down. I mean, that's quite a bit. If you look at the S&P, the Dow, it looks like, they've taken a hit, a lot more than what we anticipated. But I also expected this with the panic that's taking place now. Your thoughts?
And that was one of the things, I think that's kind of where Justin was leading into is, the initial panic that kind of hits, there's that initial sell-off. And obviously it's to have that kind of reaction, it's got to be not just, the you and I kind of doing the sell-off. It's got to be either huge hedge funds or these huge amounts of, pools that can kind of do this. But, when you look like in that short term, so like you say the last 5 days, or even going back to like the last month, it looks dire, and it's like, oh my gosh, the world's coming to an end. And obviously that can continue that fueling of people's fear to say, okay, maybe it's time for me to cut my losses and kind of further send it down. The only thing that's the bright side is, again, when you kind of stretch this out, and again, just because as an economic standpoint, like, 2020 was one of the last times we saw a huge economic fall. And you can see in the charts where, we're not even there yet. Like we're still kind of like above waters compared to just that last like world economic collapse, So I think the bigger picture is, especially looking at just a few of these stocks overall, there's been a steady decline from 2021 to now, which is, if you remember presidency, that wasn't Trump. Trump wasn't in office in 21 through 24. So we've kind of already been in a steady decline. I think that, and this is just my opinion, is something we've been kind of talking about here a lot is it's finally just the last piece that kind of broke loose, right? Like I think there's just this built up momentum of this downturn, and then now it's kind of like here's the scapegoat. Let's blame Trump. He's doing this tariff thing, and it just kind of sent it further downstream.
So, and appreciate the charts because they do somewhat bring some content to what we're trying to speak out, and specifically with the United Parcel Services,
Yeah.
right? But if you look across the whole funds and what have you in
Sure.
Wall Street, I think they've all took somewhat of a hit, right?
Yeah.
I don't think anything was safe from this particular move that the administration made. Now, with the tariffs, though, and this is a question that I have, Justin, if you're listening to us, I'm sorry that we can't get your opinion today. We really wanted to get you your thought on this here, and we'll make sure we get you out here next week. We'll schedule something to get you out here. But it's important to have a perspective from someone seeing it outside in, right?
Yeah.
And the way we look at it, we just look at our personal bank statements, or we look at our personal portfolios, and we see, oh shit. Do I pool?
Yeah.
Do I pool? Do I? What kind of action should I take, especially in this panic that people are starting to? It's starting to spread like a wildfire. Just in watching some of the social media, I've been seeing people talking about if you have your money, pull it out. And I knew this was going to happen. It's not over yet. Mm-hmm. But then you have other folks out there that been in the market for long periods of time saying, well, this is just a reaction to what's taking place, right, with the tariffs. But typically, this is where you want to take advantage of it because you can buy these at a low price. And again, it'll benefit you in the future. Now, how much you hemorrhage depends on like your financial situation. There's a lot of folks out there that are probably planning on retiring this year or the next year. Those folks may not be able to see that return at a rate that you would expect it to, and they may have incurred some losses beyond their control. But folks like you and I that are somewhat young and we're not looking to take out this money yet, it may be beneficial, right? In the long run, we're buying stocks at a low rate, and historically, someone had mentioned yesterday that the S&P was at 700 points back in the 70s. Mm-hmm. Look where it's at today, right? So we're only again opinions based on historical facts. Is that this should continue to increase, and at some point, we could benefit from that wave as well.
Yeah, and I think that's where. Again, how I think you've mentioned it a few times in our show about how people always forget. We're very short-term, memory, I guess, as far as when we look at our historical. But if you take the charts, even over the last 20, 30 years, the charts will always show that there's just a natural up and down. Like every, 8 to 12 years, we go through some kind of form of recession and growth and recession and growth. And it's always, like you said, it's the key point about if I'm retiring right now, yeah, I'm definitely feeling it. But if I'm not in that position, and if like you're saying, you and I, where maybe we got another 10, 15 years in it, in that time frame, we should see that correction come back and our overall wealth grow as a whole. So I think that's kind of where it'd be nice to get JP's input on this but like is it still the best time to jump in and start buying, or is it still wait, or is this like housing? I mean, for you, are we getting back to 2008
Well,
we're gonna lose our home values? Or
one of the things that I track, Rohi, about housing is whenever the stock market, whenever the stock market, these panics happen, right? It's like a sound the alarms. Let's go ahead and get these rates down immediately,
Yeah.
because again, you're either sounding the alarms to a recession, or you're sounding the alarms to, hey, this is going to pop. So you start seeing the bond market take a hit, or you start seeing the bond market take the opposite. But that actually has correlation to our mortgage rates. And as of maybe a couple of days back, I'll tell you that the rates did improve considerably. And because they improved considerably, obviously that made a difference for a lot of folks. It gave us some promising future, environment that, hey, this actually could go in a very bullish way, right? Especially for people in the mortgage industry. But then again, it's just like you pull the carpet right underneath, and rates started climbing back up. And I think you start seeing that again when the market improves. But recessions are always good for the mortgage industry because everything seems to come down. Rates are down.
Yeah.
Therefore, it's more affordable, more money in your pockets, because the Fed will continue to quickly do the quantitative easing and start releasing more money. So there's more credit that's available. But it's hard to say. I was listening to a guy yesterday talking about, how this reaction will create higher rates here for the near future, just within the next couple of weeks and or months. But then again, it'll come back down. So it's hard to say what to expect coming from this. But I can tell you that in the mortgage sector, rates are still somewhat in the higher, mid sixes. And you may be able to see them lower in other areas. But again, that's you paying some considerable discounts and what have you.
Yeah, I mean, I think my fear in the short term, or maybe as this kind of moves along, is at some point when corporations start, looking at how to cut their losses, and that trickle effect is going to be in the terms of jobs, and that's where when I say like the housing market or some of these other industries that are going to maybe not today, but 6 months to a year from now have the reaction to what's going on today is, people losing their jobs, and then now if that job market as a whole has shrunk, and they're not able to necessarily find that next job, they start missing their mortgage payments. That's where I guess I would say like maybe this does start into that depression kind of talk, because I think, like you said, the easing of pricing is something that, at least in like my retail side, I'm definitely seeing again. Like it's got the signs of 2019 of, like as a dealer, like, hey, here's these buying incentives, buy this at a cheap, we're having a sale. I haven't heard of the word sale in 5 years, and to finally hear like things are on sale for us, like it's kind of a sign that, all right, there's going to be some of this easing. But if you read into it, it also means that there's a lack of sales going on. Like they're having to move product that's not moving. And the only way to do that is either making less profit or hopefully not at a loss, that they're just having to get it out the door.
Yeah, it's funny you say that. You've heard the term, this is a bubble of all bubbles, right? I mean, I hear that all the time. But and the reason why they say that is because this is where all these bubbles come together and pop, right? Whether it's the stock market, the housing, and even the auto market. And as of last week, I had talked to a dealer friend of mine and had mentioned that a lot of these dealers aren't selling the amount of vehicles that they were at one time, right? That their lots are still not selling the amount of volume to keep them going. So therefore, something has to take place, right? I mean, you can only revolve these through the auctions so many times before you say, hey, I got to cut my losses, right? But I mean, you want to preserve that. Now with tariffs coming up, obviously that creates an issue for any parts that are delivered from outside, right, wherever these tariffs were placed in. But manufacturers that are here, I'm assuming that we're going to see maybe a price reduction, because you have, I mean, this is what doesn't make sense to me, right, is that, well, the reason why you went outside of the country was to make these a lot cheaper so that you can sell them cheaper to the consumer, which is capitalism, right? You're trying to create a product at a competitive rate, but now you're isolating yourself and you're saying, well, we're going to build it here. Well, if you build it here, you have to pay a standard of living a lot higher than you would out there. So how do you carry that cost? Who has to, inherit that cost?
But I guess that's where I would say that the idea of capitalism at its best is concerning, and I say that because if I can grow an avocado, for instance, in Mexico, under their rates, and drive it here, and it be cheaper than the avocado that comes from, maybe down the street, there's a problem with that. And I think that's kind of Trump's approach, is to say, like right now, if we look at what's going on with China, if I buy something from China right now, AliExpress or whatever, it's free shipping. I can get it here. It costs nothing to get it here. But if I have to go return that item, it'll cost me $100 to return that item. So that's where, like, it doesn't make sense. So the other part of it is, when you say, like, I think we talked about before, like, everybody's complaining about the cost of an egg right now, right? Well, I guarantee you that egg farmer is not getting but a few pennies for that egg, but you're paying probably quite a bit, maybe 50, 100 times that amount at the actual store. So it's not that the price went up, on that particular egg. Yeah, maybe it went from like 3 cents to 4 cents, right? But it's the person on the top end that's selling it to you. So I feel like tariffs are going to be a safeguard to say, when prices stayed the same, this is why. Well, because it costs more, right? Like, we're still selling this car for $50,000 instead of maybe $40,000 because, the cost on the parts went up. It's kind of like that scam, right? Where, yes, if you were to build it here and there's no shipping, there's no any of this like extra cost that would kind of necessarily be baked into that making of that car, it should be the same price or cheaper. But that's where like I said, it has to make sense to where if I can build a whole car, yes, maybe labor is cheaper, but when you look at transportation and all the things involved to getting it here from another country, and it's still cheaper, that it just doesn't make sense. I know wages kind of plays into that, but
yeah,
I feel like there's a huge disconnect of our understanding of why it's costing it less here. And I think most of it has to do with the transportation aspect.
And that may be the case, and this is where I think, economic policies that are made, we probably won't see the effects. Mm-hmm. I mean, maybe, Donald Trump won't be alive by the time you see this, because we're assessing economic policies that were done in the 70s and 80s, because this thing also happened. Yeah. It happened with Ronald Reagan when, there was a time and during the late 70s and 80s where, we wanted to outsource a lot of these things here, right? We wanted to give these folks, these companies here, an opportunity to generate more profits for their investors. And what did we do? We said, hey, go offshore and outsource your labor elsewhere, right? And we still became the leading technology country, the leading innovation and service-based country, right? And this is what we currently have today. We export a lot of our services and softwares and technology. Mm-hmm. But a lot of these countries have come up. They've advanced themselves, and especially in the manufacturing. Obviously, China was bring it all over here, and we'll do it. We'll do it for cheaper. Yeah. And now that's become a problem, because now they've become the leading country that probably manufactures the most, right? And this is where those trade deficits happen, and this is where these tariffs are taking place. And now it's going back and forth that I'm going to give you 104%, I'm going to give you 84%. So I don't know what that means for you and I, Rohi, but obviously if you're looking at your 401k and you're someone that is not considering being political, sometimes it's hard not to when you're looking at dipping into your pocket. I mean, I can only say I support anyone on any side of the aisle up until I know that it's affecting me financially, right? I mean, whether it's the price of the eggs or you're out $20,000 to $30,000 on your 401k. For those that have a bit more, then obviously that's going to be a huge hit, especially if you're looking to retire here shortly.
Yeah.
So when I see, like you said, it's I hate to say it, it's a scam, but the people that get
It is.
the people that get hit the most are the most vulnerable people. Those people that do invest in these 401ks.
Yeah.
Those people that do have a lot of this money that they depend on to make a living in the future. But here you are. I mean, if you remember, not to Enron. You remember Enron? That crash.
Yeah.
I mean, how many people lost their asses on that, right? And here, I wanted to bring something up because I think it's important too. I did have a screen up here, which was the Dow Jones Industrial, but I'll let you get yours out there. I think you had something in there that you wanted to share.
I think what's important is understanding like the places we're trying to take these, like Trump's attempt of like putting a tariff to bring back, for instance, American manufacturing. I think this is the picture that people have to really get in their head is, manufacturing today is not what it was 20, 30 years ago, where that meant, thousands of jobs and people on the line. It's this. This is the image that you would see now in China and some of these places. It's 100% robotic. So when you say jobs, well, opening this factory is probably going to maybe generate 20 to 100 jobs, more probably administrative. Obviously there's going to be some shipping jobs in there, but it's not 1,000 people running that line building those cars or building whatever that is that we're trying to bring back. It's machines that are going to do it because these machines don't call off. They don't have union strikes. They don't have overtime. They just work, And again, that's where when you say how can China build, this product for so little with so much profit margin, it's because of robotics. They're one of the countries doing the most advancement in robotic manufacturing. So that's kind of the lie when you say the lie is, yeah, that's great, bring it back to America, but if don't talk about jobs. It's not going to be like this whole revolution of jobs in the car industry and all this. It's going to be robotics.
Yeah, so and I appreciate that because looking at that picture, I look at obviously there's an investment for that, right? But that investment only carries so long. So if my question would go, well, like you said, what about the jobs? Does that mean that the product should be cheaper, or are they going to stay the same? Because who wants to lower their prices down when you're already up ahead, right?
And that's marketing. Your cup costs $5 because they think and know you're going to pay $5. It could cost 10 cents. It doesn't mean that they're going to go like, well, let's give Jose a break and let's sell it only for 20 cents. No, Jose's willing to pay $5. We're going to charge him $5. That's their profit margin, right? So that's my point. Is like you said, if let's say by moving it to the United States in car manufacturing, that cost actually went down. You're not going to see a reduction in that car cost.
Exactly.
They're just going to make more money.
Yeah, and you see that in our fuel prices at times, right? I mean, that's how they gouge, and I hate to say that. Yeah. But I wanted to bring up this chart because this gives you a historical average of where the Dow has been in the last, let's start off from the 90s, right? Mm-hmm. But you'll see the dips that took place here, especially in the Great Crisis, so they call it the Great Recession that happened in back in 2008. You started seeing the dip on that, and this is where markets started panicking. We saw that there, but look at the bullish run that we had for such a long time. Yeah. And then the pandemic hit, and man, that was a straight decline that we went down there. But if you notice, the 21,000 represents a huge increase, well over, what would you say? That's a huge percentage there. And now, look at over the next where we're at today. We were at 42,000. Now, obviously trailing down to 37, but slowly starting to pick up. Mm-hmm. What does that tell you, especially if you have investments? So this is kind of where I wanted to take the input from a financial advisor that's seen this. Yeah. Are you advising your people to say, pull your money out? Mm-hmm. Are you screaming to pull your money out? Again, personally, as much as I hate to see that decline in your portfolio, the way I look at it is now it's a time for you to invest more because now you're buying that at a cheaper rate. Yeah. And if historically this is the trend for the Dow Jones, then we may see this in the next 10 years at 60,000 based on the historical trends that we have. Now, again, this is me personally giving you that perspective, but it doesn't necessarily mean that that'll happen. There may be other things underway with the economy and the way things are going, but I mean, over the last 30 some years, we're able to see that the trend is always going up. And the person that talked about the S&P being at 700, he was talking about back in the 1970s. So this goes beyond the 30 years, just giving you some perspective.
Yeah, I mean, my only concern with like looking at that chart is, you have obviously a period of growth in the early 90s, like you said, and then it kind of flattens out with some up and downs, but all of a sudden it kind of, I would say, runs away, and that's where I would say, is the market well overvalued? I mean, looking at that chart, you have to wonder, where did all that growth come from? Like how did we all of a sudden go from semi-flat with maybe the CPI, like maybe that 2-3% of growth that we would normally get through inflation and stuff, but that's way more than that. I mean, that's almost doubled, since the early 2000s. So that's, I think, in a personal aspect, that's where I say I'm not necessarily ready to invest yet, because there's still the bottom maybe hasn't been hit yet. Because again, somebody'd have to explain to me of where we managed to make all of this magic money come from. Like that growth there has to be an infusion of money from somewhere. Did we print it, or what did we do?
Yes, and if I can point out here, I think, Rohi, your point is exactly right. That you're seeing the steady growth that we're having here. But as you notice, the 2000, the .com, and then we get into the housing. And then all of a sudden, if you look at all this space that exists in here,
Correct.
This space, where did this money come from? Well,
exactly.
That's your modern monetary policy. And that's exactly what's taking place, is that now you're having this quantitative easing that was a newly defined term that was brought to us to be able to explain how they correct certain things, right? And obviously, when we hit that bottom in 2008, well, it was an emergency. A run on the banks meant that, hey, that's a collapse of our financial system. So what did they do? Obviously, they had to flush the economy with more money, lower rates to zero. So they have these levers to do that. And I think what we've seen over the last couple of years, since 2022, we've seen, or late 2021, we started seeing the quantitative tightening, right?
Yeah.
And obviously they have effects. And this isn't, I don't think this is something that occurs suddenly. I think it certainly has some people deliberately put this together, and it's planned in a way, because if you want to, for the sake of the economy, these are some of the policies that you have to do in order to get us back on track, or at least avoid collapse.
So I mean, I want to. I know we're doing a charts day here, so this is where, again, why I'm concerned with that kind of a chart is because, when we look at the average debt of Americans, and this is specifically credit card debt, and we see that obviously, it's topping beyond $1 trillion now. So if $1 trillion of those dollars is part of why the Dow is so high, but it's based off money that's basically non-existent, right? It's not there, like it's owed back to somebody. Again, it just makes me think that there's going to be that correction, like that $1 trillion. At some point, the banks are going to have to get that money back, and that's going to come at a loss, because that means, everybody's going to start filing bankruptcy, which I'm starting to hear those kind of terms being thrown around with my close community. And that's where I think the overall question is going to get worse, because, again, I feel like those numbers are inflated because the spending of the average American has gotten out of control, fueling, obviously, many of those stocks that are part of the Dow. But it's with money that doesn't exist. It's money that is not theirs.
Yeah, and again, modern monetary policy. Obviously these things. I'm not saying that I'm a big fan of the gold standard, but when you listen to some of these economists that support it, obviously, once you start getting further and further away from that, then obviously your fiat currency has very, very high probability of at some point, just collapsing, right? I mean, and historically, I don't think you've seen any fiat currency that has survived outside of not being backed by some type of precious metal or some other type of reserve, right? That allows it to continue to get there, even in our history. So, I mean, it's funny to see that, Rohi. And as we continue to talk about, you know, the economic state, these tariffs, obviously people do panic. You see it in social media. Where's my money?
Yeah.
Protests are now starting to get, I mean, essentially it don't take that long before you tip, you know,
Correct,
you tip the other way and you start having a mob just saying, hey, we're no longer in support of this because our economy is going down. You can only blame it on the past administration for so long because a lot of the actions that are taking place now are starting to stir up, and maybe it's a good thing to stir things up. My understanding is that you want to purposely crash it so that you can start bringing things down, like you said.
There's still money to be made on the crash. You just you short the stock. And
Correct. But
your
again,
money.
you're trying to come down to where, like you said, maybe it's overvalued. You want to bring it down to reality, right? And maybe this is helping. So obviously we got to stand by. For those of you that are economic experts, obviously you may have a different perspective, and we'd love your comments, and you can share that with us and share with our community so that we know how to protect ourselves in these economic times. Ron, you wanted to share something there?
Yeah, so I mean, I brought up your chart here, and you know, because you said the word, you know, you're talking about gold and the gold standard, but so here's your Dow and how it's progressed over. It looks like about the last 30 years. Now, if I go to the gold value, it's almost identical. If I overlaid it, I would almost guarantee that the two somehow correlate together. So that's why, you know, when people say gold is an investment, you know, it's gold's always been taught as, yeah, it's a hedge against inflation and whatnot, but gold its price should always mirror essentially the value of a dollar and like what you can buy with that ounce of gold. So I mean, like, so there's nothing that says it shouldn't. If the Dow's going to go up, gold's going to go up.
Yeah,
you know?
and that's a good. I like that because when you say it's just another picture in time of what that dollar's worth. So at one time, Rohi, and I'll bring this back, gold was worth $35 an ounce.
Yeah.
What does that tell you about our dollar?
Yeah, no,
I mean, what's the, because when you say $35 an ounce, and I'm talking maybe late 70s, 80s, but now at $3,100, that means that you're debasing that value, or that dollar is worth very, very little.
Yeah, and that's exactly my point of when people say, why are things going up? Because your dollar is going down. It's not. I know they argue it because they'll play the shell game of saying, well, yeah, but the dollar against the peso or the yen or the whatever, it's trading. You know, no, the dollar is getting worthless. You know, and like I said, because if you were to take what, like you said, what a dollar buys me today versus 5 years ago, 10 years ago, 20 years ago, it's very easy to see that across the board. We talk about gas, maybe milk. Some of these basic essentials, like maybe how much does it go towards a house payment, you can easily see that your dollar has dissolved in its buying power. So because of that, the natural reaction is obviously things are going to cost more because it doesn't go as far, And again, if you're worried about that, all it means is that's supposed to be the cue to go buy gold, is because if I have a $20 bill or I go buy $20 in gold, in 10 years from now, I will still either have a paper piece of $20 bill, which buys me less, or the gold that has now accumulated value, but still should buy me that same amount as I'm buying today. I mean, that's the overall principle if you believe in what gold is there to do,
No, you're absolutely right. And I think, like I said, whenever you buy the gold, you're not buying it to try to get rich. You're just buying it to preserve the value of that day, right? And I recall back in, maybe this was probably 7 years ago, I spoke to someone that was looking into gold, right? And I was saying, wow, shoot, $1,100, man, that seems awfully high for gold, right? And nevertheless, I said, well, I don't have a lot of money, but I'll buy me a coin or something, right? Just to see how that would play out. And sure enough, I think silver wasn't too far from it either. Silver being a little cheaper at I think $11 or $12 an ounce. And before you know it, I mean, you look at the price of gold now. Again, that's just giving you a picture of what the value of that dollar was at that time.
Yeah.
So with inflation, obviously, you know, that means you need more dollars to buy more goods, and that's going to keep as you continue to pump in more currency into this economy. That's going to create some of these actions that you see with the gold prices and or silver.
Yeah.
But looking at it, Rohi, it's scary to think that we thought that it would never reach to 2,000.
Yeah.
And now one may say that in order for us to make gold our reserve currency, or to make it as something that's backs the dollar, you'd pretty much have to be somewhere between $10,000 to $15,000 an ounce.
And maybe, you know,
Maybe
putting
more.
the tinfoil hat is that maybe there's a conspiracy to raise the price of gold, so we sell our gold reserves as a country because we got to recover somehow, you know.
And I don't.
He was just at Fort Knox checking on our gold reserves. To
right.
kind of
And
see
I don't
where
think he
we're
found
at.
anything yet. Right? He goes, "Where's it at?" Right? Interesting.
Yeah, I mean, I think the safety net for me, and again, why I think a lot of people like gold is, you know, right now, if I was to buy shares of any kind of stock, whether it be UPS or whoever, I mean, I know at some point we want to trick ourselves to thinking UPS can never go out of business. It can never go bankrupt, but it can. Companies do all the time by maybe a poor decision or maybe an economic downturn of some kind that's out of their control. But gold is never going to go to zero. Gold is never going to become a point where we just go like, we don't. It's worthless. You might wipe my butt with it. You know, like it's not going to come to that point.
Yeah.
So that's why it's still, I think, the preferred safety net for a lot of individuals, because it's something you can hold. Now, the only way that would maybe go to zero is if a large meteor that was completely solid gold broke up over the Earth, and we all got a ton of gold in our backyard. Then it would obviously go to zero. But that's not the case.
I think the fact that it's scarce, and it takes a lot of work to mine.
Yeah.
Obviously, that's what makes it so valuable, right?
Yeah. Well, you say the two words that go with exactly the other thing of what it mirrors, which is Bitcoin or any
Bitcoin.
kind of digital currency. It's hard to get. It's
Hard to mine.
It's hard to mine. It's in a controlled release or controlled substance. You know, obviously with Bitcoin, it's had a little bit more of a roller coaster in a short period of time, but that's another, I guess, appeal of something of a digital asset is because you said exactly the same words about why a Bitcoin or any of these digital assets are of value, is because that's all gold is, right? We need a scale. We need something to be able to say, this is our goal mark, and now we decide, okay, how much is this worth, and how much do we sell something for? You can't base it on the dollar, because we can just print another $1 trillion tomorrow if we wanted to. You can't, base it off the amount of air in this room, because it's something that's very volatile, right? But when you say something like gold,
A metal that's scarce.
it's not just scarce, but like, again, you can't all of a sudden, or maybe, you could, but you can't have this large reserve that just pops out of nowhere. Like it's going to be very already, probably by design, like they're only going to mine a certain amount because they know if they mine too much, then the price is going to dramatically drop, just like Bitcoin.
Yeah, and the thing about Bitcoin or any of these cryptocurrencies is that they're decentralized, right? They're not
supposed to be.
Yeah, well, that's the thing. Now, looking at Bitcoin, if you recall, Rohi, even back when Bitcoin was at $19,000,
I was in it before then,
and even up to 50,000. Who'd
Yeah.
ever thought that this would go beyond 100,000?
Yeah.
If you look at the historical there, and it seems like it's climbing up, right? It's getting to a point where essentially we may see it out there. If we look at these economic trends right now, people are scared. They're pulling money and they're trying to put it in safe assets.
Yeah.
And gold being one of them. I think that's always been something that people have preached, especially that are very pro gold.
Yeah.
You heard earlier on last year that Warren Buffett was removing a lot of his monies from his from a lot of these funds, and who knows?
Almost in preparation.
It's like wow. It's like sometimes it's hard.
He's a prophet. What do you mean?
Yeah, exactly. It's hard. Not. Obviously, if I had that kind of dough that I could do,
Yeah.
I'd probably. I'd hire somebody to be closely monitoring him, right, to find out how he's going about all of his trades, because obviously he knows something that we don't.
Correct.
And when it comes to trading, a lot of people that like to trade, you know, obviously you have to be pretty much advanced in what they do, because a lot of this has been taken over by AI. AI is very smart in its algorithms. They know when you're looking at Robinhood.
Yep.
They know if you're thinking of buying it, then they'll sell it to you just a bit higher, because they understand how that is. By the time you make the transaction, you bought that a little bit higher.
Yeah.
And it's funny how all that works, but see, you and I probably don't have the insight to that, you know, and
Yeah.
we don't own those machines and software companies that operate these things to be able to make that. You have that edge over a lot more people. And you could imagine if you can take, I would always say this, if you can take 10 cents from every bank account, or a penny from every bank account that exists on any given day, I mean, you could imagine how many millions of dollars you would generate.
Yeah,
Well, you imagine the stock market is no different.
And I think 2020, if I recall, I mean, a lot of that crash was not the human fear; it was the AI-driven. You know, because we're leaning so heavy in our trust of AI that, you know, it saw whatever it needed to do, and it said, okay, no, we're going to dump, and they had to put hard stops of like, no, this is too much, like this is too much, right? And like you said, it's understanding that it's not one AI that's running the stock market right now. It's a weaponization, right? Like if I have a brokerage of some kind and you have a brokerage, I'm trying to train my AI to trick your AI to maybe dumping, and then I'm going to buy, right? Like there's all kinds of like weird strategies that go on, because they know at the human level, there's no more like these guys watching monitors and like making these phone calls. They're just kind of sitting back and going like, all right, the computer's at the helm right now. It's driving this thing, and I don't know why it's deciding to buy more of this or why it's saying to sell more of this, but it's making us money because it's tricking this other AI to do something responsive to that.
It's to the point where it's quantum computing AI that honestly, I mean, I don't think any human can really see that already.
Yeah.
And this is why the coding has kind of, you leave that to AI now, because they can do that. You know what's funny here, and this will be probably another segment that we can have,
Yeah.
Rohi, is exactly AI. Just the other day, you know, I was talking to my wife, and as she's going through school, she's starting to utilize tools that they give her at school, right, to put notes and what have you. But there is AI out there that can pretty much, you know, help you put out a podcast with two artificial people doing the podcast based on the notes you brought down, or you inputted in the AI generated program that it has. But I'm telling you, Rohi, I mean, they may even make an AI of you and I,
Oh, yeah.
right? And I mean, just based on our voice and our mannerisms and what we do, our gestures, you can certainly bring something up. So next time you see us, make sure it's us. You know, we'll have to pinch and make sure that we're there, right?
Agreed.
Anyhow, this is a fully packed show today. I mean, financial, just some financial perspective. Again, we're not financial advisors. We did have a financial advisor earlier on, and I'm sorry we lost him due to the
looks like we'll reschedule,
technical
he says.
difficulties, but we are going to bring him back. We'd like to have him here live so he can give you his perspective on what he sees. Hopefully we can bring him back next week. Justin, if you're looking at us today through this podcast, thank you again for the small amount of comments you made there. Much appreciated. We'll bring you back, and we look forward to getting your knowledge on what's taking place with the market as well. But other than that, like, subscribe, keep us going, and share. More importantly, share. Rohi, anything else you'd like to say before we?
No, that's all. I mean, I just hope this roller coaster doesn't go too bad. That's all.
Well, we'll update you next week. That's for sure. All right. Well, thank you for.